Wow, good afternoon. Good afternoon and welcome to another webinar Wednesday, hosted by the CSU Bakersfield Small Business Development Center. Good afternoon, I'm Kelly Bearden. I'm the director of the CSUB SBDC, and I'll be your host today. And we have I think, an outstanding program. We have the doctor. The doctor is in the house today. The godfather of economics in the southern San Joaquin Valley, heck, the entire San Joaquin Valley, Central California, and more. So we have Emeritus Professor Dr. Mark Evans joining us to talk about really one of the big topics that everybody's talking about these days, and that's where is this economy headed and what is happening out there. So what's up today, May 11th, 2022. Everybody's focused on the economy, and so are we. So we are going to get a big dose of the economy. We're going to be talking a little bit about our update on open pandemic relief programs. We're going to take your questions and have a poll. And I might even throw in a Bill Clinton impersonation when he came up with that famous quote, "It's the economy, stupid." Okay, I'll work on that. But really, it was really one of the best quotes that Bill Clinton had during his presidency, and probably cemented the last 4 years, a second term, when he realized in 1996 the economic issues that were going on in this particular country, and for him to focus more on that than some of the other things happening in the world and in actually the United States. So it's the economy, stupid. So anyway, with that, it's actually better some days, but not today. So we're going to jump into our polls, and we do have some economy-related poll questions today. So let's get to our polls. And our poll questions today are all basically, again, economic-based. And the first one that we're going to launch is, what economic condition worries me the most? Is it inflation? Is it unemployment, jobs, finding employees? Is it recession? Is it the threat of recession? Or is it the trade deficit? Or is there something else? Is there another economic issue that is bothering you? If so, go to our chat and put it in the chat box, and we'll review that. But simple question, it's going to be the easiest one to answer today, is what economic condition worries you the most? Inflation, unemployment, and that even goes back to jobs and finding employees, recession, or the trade deficit, or something else. So we're getting some solid participation today on a good-looking Wednesday. 62% of you are in for the simple question, what economic condition worries me the most? So is it inflation? Is it unemployment, jobs-based? Is it recession? Is it the trade deficit? Or is it something else? Okay, we are going to end this particular poll, this very even poll, I might add, and share the results with you. So with 66% of you participating, here we go. And we see that actually inflation. It is inflation. It's inflation that is really concerning half of you, 50% of you, while 25% of you are worried about a recession and 25% are worried about unemployment, jobs, finding employees, and where it's all headed with workers in the United States. So thank you. I believe we did have maybe something in chat. We'll look in a little bit, but we will stop sharing that poll and move on to our second poll question. And our next poll question is going to be the pop quiz version that we like to throw out there. And it's going to be based on recession. And it's simply, when was our last recession? When was the United States last in recession? Was it in 2020? Was it in 2009? Or was it in 1975? So giving you three options on when the last time our economy was in recession. So we're getting close to that golden 60% participation rate. And it's a simple poll question this week of When was our economy last in recession? And having 67% of you in right now, I am going to stop the poll in this poll question with 67% participating and share the results with you. And 65% of you think it was 2009. Another 25% say 2020, and 10% of you say 1975. Our economy was in recession last, and it's really kind of sneaky how that snuck up on us in 2020 after COVID first hit, and we had our stay-at-home orders. So 25% of you were correct. It's easy to go back to the 2009 because that was the Great Recession. The big recession that everybody remembers, the long, painful, and really the fact that oil kind of drove at least Bakersfield and the Kern County region out of that recession much earlier than other areas. But for most individuals and most people, it was a tough time, the 2009, whereas 2020 rebounded quickly after a very short half year or so. But we'll let Dr. Evans talk a little bit about that in a little bit. So yes, we were in recession, a mild one in 2020. So our third poll question is going to be kind of a two-part question. And it's just kind of like, since everybody's concerned about inflation, let's go here. Inflation is measured by the Consumer Price Index. How is this price index measured? Is it by bots checking prices on websites? Does it use kind of like a Nielsen ratings for like Nielsen TV ratings, and family are actually chosen and then are analyzed? Or do actually government employees carry out the task of measuring the Consumer Price Index? So is it technology-based with bots? Do we have Nielsen families that where we really take a sample of maybe whatever the number is, a number of families around to see what they're buying, if it increases, or do we just simply use government employees? So we do have 37% of you. A different question for Webinar Wednesday, but kind of gives you a preface for where we're going today with inflation and how everything is calculated, how we end up with this 8.3% number in April today. But with 48% of you in, I am going to go ahead and end this poll. Inflation is measured, and half of you, or almost half of you, say 47% of you say that it's government employees, and you're correct. Government employees actually do the manual checking of prices in each particular field, be it energy, be it the grocery segment, be it other segments that we monitor and check for prices as they go up. 29% of you, and makes total sense to me, that there's some type of Nielsen ratings that is done, and bots checking prices on the websites probably is coming, but right now it's the old-fashioned way of government employees. And so with these government employees is our last question. For groceries, for example, for groceries, how many government workers are at grocery stores? So the government workers actually are in the grocery stores watching the prices and analyzing the prices. So around the country, do we have 58 of these such workers? Are there 477, or are there 2,337? So, as in some things in life, more isn't always better, at least in my opinion. So we have 58, 477, 2,337. And 36% of you are in. We'll end this poll quickly, this frivolous poll on how many government employees are in grocery stores around the country, measuring the cost of groceries each month to see if they go up. And we're going to end the poll right now, have 48% of you in. And our last poll question, sharing the results, 47% of you say 2,337. It is actually 477 with 35% of you. I mean, who would know? Who would know this answer? But just kind of a fun way to end it. There are 477 government employees around the country in grocery stores actually watching the prices and analyzing the prices to see if the consumer price index increases or decreases in any given period. So thank you for participating in our poll, and let's get moving along. So getting back to a few little slides here. And so moving along a little bit here, let's jump into some pandemic relief, do this rather quickly on what's going on and get Dr. Evans in here. The California Dream Fund, if you're interested in starting a business, and there is $5,000 to $10,000 available for some people that start these businesses, where you get free consulting, free training, assistance with a business plan, and hopefully the $5,000 to $10,000. Email CASBDC, short for the California SBDC, at ucmerced.edu. Also, the Kern County Micro Program is open. There's plenty of time, and there's plenty of money left. Actually, the first checks have still not gone out in this program that we've talked about in January, but we're hoping that this happens next week. We're the first recipients in Kern County. But everything's going to be going much quicker and much smoother, is the guidance from the state of California. Some of the changes on our third iteration of application forms that have been kind of mandated from the state to change some of the questions asked and answered by our small businesses. Mono County Grant and Forgivable Programs open. Contacted Jeff there. Our EIDL loan program is actually now closed for reconsideration and increases. You can still submit. If you got in under the wire there, you can still submit some information to them, and you will need to close that loan in about another week. So everything needs to move really quickly. It is closed for all intents and purposes. The employee retention credit is open retroactively, going back in time to periods of 2020, basically the fourth quarter and the first 3 quarters of 2021. An amended payroll tax return is necessary in order to do that. The City of Bakersfield restart is closed. We'll be talking in the next few weeks or maybe months about these new loan programs, and also some entrepreneurship programs for new businesses that'll be coming as part of the state small business credit initiative. So that stuff is going to be coming. We'll be talking about that more. If you did apply through Lendistry.com and did not receive the California Relief Grant that closed about 6 months ago, they're still funding businesses. So do go back and check any emails, any junk, any folders, anything over time. Do a search on Lendistry, spelled Lendistry, and see if there's something out there. Surprisingly, we're still seeing people that are getting funded for this program that's been closed for several months. Forgiveness is open. It's not forgiven, though, until you actually go through that process. Then it's a loan, so get your forgiveness done if you haven't done so. And restaurant revitalization funding did pass the House. So maybe it can happen, but probably not. Talked about, I'm not going to talk much detail on this stuff this week because we've got the doctor in the house, but we will be in the next coming weeks giving you a little more guidance and information on these particular pandemic relief programs that are still open. The California Dream Fund grant, we have you contacting ucmerced.edu. And now it's my pleasure to introduce Dr. Mark Evans. And we do have a doctor in the house, and I do believe that he is the economic guru of the entire San Joaquin Valley and Central California, for that matter. Dr. Evans retired. Well, we say he's retired, but he's working today. So what can you say about that? He did retire after a distinguished 38-year career at California State University, Bakersfield, having joined the school in 1978, officially retiring in 2016. But really, even though he does spend a lot more time on the golf course, is he really retired? I don't think so. Dr. Evans went to school at the university, actually New Mexico State University in Los Cruces, New Mexico, where he not only met his better half, Becky, but he also grew fond for the green and red chilies of New Mexico. So in his spare time, Dr. Evans talks about economics, and more economics, in addition to his golf game. Trying to find golf partners is very hard when all he wants to talk about is the consumer price index and certain other things. Mark, it's a pleasure to have you on here. I value our friendship. Thank you for joining us. Take it away.
Hey, thank you for inviting me, Kelly. I refuse to accept the title of guru. My colleagues at CSUB are simply too good for me to claim to be the guru. But at any rate, let's talk a little bit about let's start with the pre-pandemic, how policymakers looked at the economy going into the pandemic, and then why what they did made a certain amount of sense, but why also at some point, I think they got off track a little bit. So please go to the next slide, Kelly. Okay, so what I've got here is annual data on GDP, unemployment, and inflation for the 3 years prior to the pandemic. And first of all, in terms of what policymakers were trying to do and what they're continuing to try to do is achieve the lowest unemployment rate attainable with a steady state inflation of 2% or so. And generally, there's knowledge that the economy is changing all the time. So whatever knowledge we do have, we have it just from inferring what's happened in the past, realizing that that's changing all the time. And so, going into the pandemic, what were the main inferences that macroeconomists held? I think one is that for years we've believed that there's an unemployment rate that'll trigger higher inflation. And we're always trying to figure out what that is. We never know for sure. We're pretty sure it was over 6% in 1980 or so. And if you look at this last 3 years of data going into the pandemic, I think that what was on people's mind is, what is this inflation trigger now? Could it be 3.5% or so, where we can, bring the unemployment rate down to 3.5 without really triggering inflation? Seems like we've done that. Well, maybe it's even lower than 3.5%. Okay. Also, there were a lot of studies that were suggesting that even though we don't know exactly what this inflation trigger is, it looks like that the economy's more sluggish than in the past in terms of the inflation rate accelerating when the unemployment rate gets too low. So I think there's a feeling that we could push the envelope a bit in terms of bringing down unemployment, and there was less of a risk of increasing inflation than earlier in our history. And then finally, after a lot of experience, I think Fed policymakers basically the strategies they followed was that if there was an increase in inflation and it looked like it was transitory, supply side oriented, that they could safely just accommodate it, make sure the unemployment rate doesn't go up and the inflation will pass. Now, the price level will go up, but it'll go up and at some point not keep accelerating. It'll go back down to that normal 2% or so range. But if there's a persistent demand side, labor market inflation, where labor markets become overheated, it is necessary to slow the economy, increase the unemployment rate above this trigger, whatever it is, and to prevent a self-fulfilling wage price cycle. And looking ahead a little bit, what makes the current situation extremely challenging is, what if that inflation is actually a little bit of both, which it is? What if it's supply constraints, but at the same time overheated labor market? I think we go on to the next slide. So to try to put this into a picture, on the left, what's happening is the orange dots represent unemployment rate holding steady. The blue curve is a burst of inflation. So if this burst of inflation was transitory, then the idea was we could hold that unemployment rate constant. We could accommodate the inflation, and what would happen is that burst of inflation would eventually exhaust itself, and the inflation rate would fall back down to 2% or so by itself without us engineering a recession. What you see on the right is what happens, or what we believed would happen, if you got this temporary burst of inflation, but the unemployment rate was actually below this inflationary trigger. In other words, a very low unemployment rate. And here what you see is if you try to maintain that unemployment rate at, I'll call it an unrealistic level or an unsustainable level, inflation actually accelerates. And notice I'm not saying that the price level is going up, but I'm saying the actual inflation rate, which is the rate of change of the price level, even that is going up higher and higher. So you'll have maybe 2% inflation, then 3%, then 4%, et cetera. Next slide, please. So again, on the left, you've seen that picture on the previous slide. If it's a transitory shock, you can maintain the unemployment rate as long as it's above that trigger, and inflation rate will eventually exhaust itself and return to, the 2% inertia. Now, what if it's not? What if it's an overheated labor market? Well, on the right, what that diagram is showing is that you can bring the inflation rate down, but notice the way you do it is you're going to have to be willing to increase that unemployment rate temporarily. That's a recession, and that as the slack develops in the labor market, eventually what that does is it decreases the price wage cycle, and you can eventually get the inflation rate back down to your target again, but only by living through a recession of some kind to really take some of the heat out of the labor market. Okay, so let's look at what happened then on the next slide. So basically, the macroeconomists and economists at the Fed have this idea of they've got to figure out how to respond to the pandemic, and to do that, they've got to kind of form some assessment of whether they can accommodate the inflation and the pandemic without triggering inflation. So going into the pandemic in 2020, we knew the economy was collapsing, and collapsing seriously. So on the fiscal side, we passed the $2.2 trillion CARES Act, added another almost trillion in December. And then what the Federal Open Market Committee did is they lowered that federal funds target to nearly zero. They announced it was going to stay zero for as long as it took for the unemployment rate to go down to its lowest level, which they were probably thinking something like 3.5%. And the inflation rate returning to the 2% target. And then they purchased massive amounts of debt securities to try to hold down long-term interest rates. Okay, now if you look at the chart, notice that it worked. Okay, in the first quarter, GDP fell by an annualized rate of 5%. In the second quarter, it totally collapsed, falling at a 31% annualized rate. But notice that the policies took hold, and by the third quarter, there was almost a complete bounce back, where GDP grew by a third annualized. And in the fourth quarter, it grew at a more sustainable 4.5%. The unemployment rate blew up to 13% by the second quarter. But then by the fourth quarter, it was back down to 6.8%. And inflation, despite this massive stimulus, inflation by the end of 2020, the fourth quarter, it was running at 1.7%, which is essentially what the Fed's long-run target was. Okay, so that's year one. Now let's go into 2021. Next slide. And here's where I think the missteps were taken. And the result of these missteps is we turned what was essentially a supply-driven inflation to an inflation that had both the demand pull and the supply side elements. So it basically turned the inflation into, in terms of causes, all of the above. How did this happen? Well, in March, we threw another $2 trillion at the economy. The Congressional Budget Office estimated that the economy was running around $50 billion a month below full capacity, but that the multiplier was working and that by the end of the year, we'd only be running about $20 billion a month below capacity in terms of needed stimulus. However, this Jobs Act added $150 billion a month. Okay, so many times more than was actually needed to get to what economists considered, or what the Congressional Budget Office considered full capacity. Now, what would normally, or what we would hope would happen in a situation like this, is everyone pretty much understands that discretionary fiscal policy is pure politics. Okay, politicians do whatever politicians think they need to do to get reelected. And the Fed's job is to kind of independently either support or offset what the politicians are doing to best achieve the macro goals over the long run. And so at this point, I think what the typical economist was thinking is politicians are going to do what the politicians are going to do. Hopefully the Fed will now step in and offset it to create a stable macroeconomic environment. But remembering the previous slide, what was happening in the fourth quarter of the previous year is unemployment was still running at, I think, between 6 and 7%. It was coming down nicely, but I think the Fed, based on what happened pre-pandemic, thought that they could really continue driving hard in terms of easy money all the way till it got down to 3.5 or so without stimulating inflation. But they didn't take into consideration, I think, that how massive the stimulus was, and they looked at their role as they've got to accommodate or support what the politicians, legislature and executive branch were trying to do, right until that unemployment rate came down to 3.5% or so. Now, I think what they should have realized is that, and they did, but in retrospect, it didn't matter, is that inflation takes off with a little bit of a lag. So the economy was moving very rapidly, even if inflation didn't accelerate in 2020. It never does, immediately. It always waits a little bit in terms of there being a lag effect. And you can see what happened here is by the in the fourth quarter December meeting in 2021, the Fed basically announced that they were going to continue with their previous policies. Then if you look what was actually happening, inflation all of a sudden was 7.1%. GDP was growing at about 7%. The unemployment rate was now in the low 4s. So over the next couple months, they said, oh, gee, maybe this inflation is not, a big chunk of it was transitory based on supply chain issues and labor force, people staying at home, et cetera. But maybe there's it looks like, well, basically they finally became convinced that there is a demand side problem too. Okay, let's go to the next slide. So in March 2022, that's when the Federal Open Market Committee basically said, we're changing course. We now have confirmation that the labor markets are overheated. Price pressures are much broader than just a few isolated sectors having supply chain problems. So they announced that they would be increasing the federal funds rate, as you know, throughout the year, and they expected it to reach 2% by the end of the year. And as we speak, they're starting to pursue quantitative, basically undoing quantitative easing. So that's where we are. We're in a situation where the Fed is trying to achieve a soft landing where they can disinflate, but do it without really engineering or inadvertently causing a recession. So with that, Kelly, do you have any, how can we best proceed, Kelly, where we can try to look at this from the point of view of what its implications are for small business?
Well, we're going to have a discussion, and we're going to have a discussion on all of these key topics, everything from inflation to recession to interest rates to labor markets to everything, where everything is going. It was a great example of where we've been and how we got into this mess, but now how do we get out of it, and how is it going to affect small businesses moving forward? And what are some of maybe the things and some of the small business strategies that we can come up with? But I'm going to ask you some questions, and I'm going to encourage our audience also to go to the Q&A box. And if you have a question for Dr. Evans, please put it in, and we will hit those Q&As routinely over the next 30 minutes or so. But until then, I'm going to start firing them off, the ones that I have. And so last week, we saw the Federal Reserve meet, and it was not a shock that interest rates were raised. There was some discussion on how high they would go. And so interest rates were raised last week for the first time in quite some time. So, Doctor, what do you see happening to interest rates moving forward?
Well, you know, the Open Market Committee's median forecast is that they will continue increasing the federal funds rate, and the median guess is it'll end up being about 1.9%, or let's say 2% by the end of the year. Macroeconomists have devised policy rules, you know, over the last couple decades that describe what they think the ideal countercyclical policy would be, you know, based on where the unemployment rate is compared to what the inflationary trigger unemployment rate is, and where inflation is relative to the 2% target. And these rules that have worked in the past suggest a much larger federal funds rate increase is needed than the 2% that the Fed is forecasting. So there's a lot of forecasters that really think, well, they're thinking a couple things. One is, okay, the federal funds rate, let's say it goes up to 2%, but what really matters for decision making is the interest rates adjusted for inflation, or real interest rates. And they're actually going deeper into negative territory right now, which also suggests that you're probably going to need much more than 2% by the end of the year. So I wouldn't be surprised if the Fed has to reassess and actually raise their target for the end of the year to maybe something more like 3% or more from the 2% that they're currently projecting. The reason I think so is, well, how does tight money work? Well, tight money works it affects the demand side of the economy. It's more difficult to obtain credit. That slows down spending, that raises unemployment, and it's that slack in the labor market that actually winds down the demand-driven inflation. So I think we're in for even higher rates probably than the Fed's announced.
So we got a 0.5% increase last week, and I think I heard the good doctor say he's projecting another 1% increase, another 100 basis points, as you economists say, moving forward throughout the rest of the year, the more than a half of a year left.
Well, no, what I'm saying is that's what the Fed says they're going to do. I think as the year goes on, they're going to see little progress on the inflation front, and they're going to say they've got to raise it by more than that.
Okay. And that makes sense because, higher rates do tend to slow down spending. It makes capital projects more expensive. If businesses are looking to expand, it costs more money, and it actually works to slow down some of the labor markets as well, too. True?
Yeah, and as you've reiterated ever since I've known you, I think what boils you more than anything about small business is how they lack access to capital from a lot of the mainstream financial institutions. And so I think we're entering a period where that's going to really frost you because it's going to be tough. There are a bunch of programs out there now that you're much more familiar with than me, but I'm thinking if if you're desperate for capital, you're going to probably have to pursue some of these more non-traditional avenues, would be my guess. I don't know.
Well, it's going to definitely be higher cost of capital. Money is going to be more expensive, and they're going to be tied to these increases that the Fed does, since they go up to the prime rate and they go off of discount rate and some other things. So since most small business lending is variable based, it's based off of these plus a spread, it means that they're definitely going to be going up. Let's shift over to inflation. So with inflation last month, we saw it spike on a basis. And I think you made a pretty good point I picked up on, is that the inflation rate is tied from an increase from, say, last month to this month annualized, if I heard that correctly. So when we hear that the rate today edged down to, I think, 8.3% for April, it was 8.5, which is an annual basis. Actually, it's that increase over that 1 month period of time and then figure it out over 12 months. So with that being 8.3%, have we actually peaked now, and are rates going to start coming down?
Well, I think it can bounce around from month to month. And, when you get a movement of 8.5 to 8.3, that could be just noise. I think you'd have to see a longer track record than a month to really start drawing inferences that it's winding down. What the Fed is forecasting, I think, I think they're overly optimistic in that in the fourth quarter of last year, inflation was running at more than 7%. This year, they're forecasting that for the year as a whole, 4.3, and then back down in the 2% range, like 2.7 in 2023. And how are we going to disinflate that rapidly when they're also forecasting the unemployment rate is not going to increase beyond 3.5%? So they're thinking that they can bring it down to where they want to be without really increasing unemployment. To me, that suggests that they think it's all transitory, and the transitory part going to go away. And I don't know, when average hourly wage is going up 5.5% or so a year, and that's getting baked into wage price spiral. So I don't know how they bring it down that much. They're trying to achieve a soft landing, but I think the mechanism that brings down the inflation is slack in the labor market. So I don't know. I think for that reason, your inflation is going to be a little bit more persistent and not come down as quickly.
So we showed charts where with the last time we had hyperinflation back in the 80s, more or less, late 70s, early 80s, that essentially we were saddled with high inflation for literally 4 years or so, 3 or 4 years. Is that kind of customary? Is that what you could see potentially happening out of this?
I don't think for that long. I guess the part of the Fed forecast I just have trouble with is that it's not going to come down, at a better rate than that, unless they accept the fact that they're going to have to create slack in labor markets to do it. And if they, they're forecasting that the unemployment rate above 3.5%. Now, if that's actually their intended goal, that it not go above 3.5%, then I don't see anything happening that's sufficient to start winding down the inflation rate, other than that little bit of it that's transitory, that maybe we'll have some better luck in the future.
So what do small businesses do with continuing inflation? We have in the past talked about pricing and pricing strategies and pricing increases. I know some of the, it's almost inevitable. And some people think, some of the small businesses we work with think too much like consumers, and they don't like price increases. But it becomes to be an inevitable, or really super important, that they do pass those costs along. Earlier this week, we saw an article where there were a few nursing strikes going along, and essentially the provider said, well, we're going to pay the nurses a lot more money and we're just going to pass it along to the consumer. And that seems to be a common strategy for a lot of businesses and moving through, but it really kind of keeps inflation going, correct?
It does, but if you own a small business and you say, I'm going to try to stop the inflation rate for the whole country by not passing along my price increases, your margin's going to shrink to the point that you can't pay your bills. So I think the way I would look at it if I owned a small business is we're entering an environment where more and more of your competitors are going to be passing along those cost increases. So that gives you kind of the wiggle room you need to pass along yours.
Yeah, the bigger product, the bigger consumer product manufacturers or bigger businesses, they like using a concept called shrinkflation. And that isn't, the hourly rate going up at their analyst or their psychotherapist. Shrinkflation is basically what we all experience when we go to the grocery store and other places. And that is reducing the quantity of a particular product while the price remains the same and acts as a more or less price increase. A lot of small businesses, it's tougher to do, but there are some creative ways of doing that. For example, maybe it's in a service type business, it's making the service maybe 50 minutes for the first, instead of the first hour. If you have a different rate where the first hour, reducing it to the first 50 minutes, 45 minutes, something like that. But there's a lot of creative ways that small businesses try to use that concept of leaving the price the same, but reducing the quantity. Of course, in the hospitality business, we can see it in restaurants. If you notice that the size or order of the French fries, for example, is smaller. But really, there's not a lot of great ideas on how to really bring those pricing strategies forward and using some type of a reduced quantity when moving forward with your pricing. Doctor, let's move on. Let's talk about the availability of labor. It's funny, we had a labor report that came out last week that talked about labor is, we added like 400,000 jobs in the economy. And last week on Webinar Wednesday, I talked about a report that came out that said more employees quit their business or quit their job in any other period. So any other period in history. So we had more quits and more new jobs in the same week. How did this happen?
Well, I think they're related in that labor is optimistic they can find another job if they quit. There are now 1.9 job openings for every unemployed person. So this is basically the negotiating power has shifted to employees. So or to the supply side of the labor market. So this is going to really be important to small business owners going forward. How do you and if you look at the labor force itself, it is almost completely recovered all the people providing labor services that it lost during the pandemic. Labor force is only maybe 500,000 less than it was pre-pandemic, which is really trivial given the size of the national economy. So there's not going to be much more growth in labor force. So I think the negotiating power is with employees, going forward for a bit longer. And I think what this implies is you really have to think in terms of how do you recruit employees, how do you retain the good employees you have, and then secondly, I'm sure that has to enter in when you're trying to figure out, when they're negotiating salaries, because you do not want to lose them.
Yeah, and even beyond salaries and looking at some of the fringe benefits and some of the other things and time off and healthcare and some of the other things that might not have been on the table beforehand are becoming much more important in order to retain employees that you already have working for you. So yes, that's going to continue to be such a dynamic area. Let's move to recession, Doctor. Everybody loves a good recession? I don't think so. So, in our poll question, we mentioned there was a 2020 recession, and also it's maybe possible to even have a definition of what the definition is first, talk a little bit about the 2020 recession, and then what's happening and when can we expect another recession?
Okay. Your question was a little bit tricky in that we probably think of recessions as being a decline over a long period of time, but technically what the definition is 2 consecutive quarters. And that's what happened in 2020 is the GDP 2 consecutive quarters in the first and second quarter of 2020. But we kind of forget it because it fell by almost a third in the second quarter, but then it bounced back by 33% in the third quarter. But technically, it was a recession. Now, GDP actually fell the first quarter of the year. So you could ask yourself, does this mean a recession is imminent? Because if it just falls in the second quarter, then technically we're in a recession already. I think the first quarter is an outlier. GDP is not weak at all. What happened in the second quarter is GDP measures production on US soil, okay? And what happened is sales were terrific, but a couple things. One, we were producing a lot the previous quarter to build inventory as a buffer against supply chain issues. And then in the first quarter of this year, much of the really large amount of sales was taken out of inventory to bring inventories back down under the idea that maybe the economy is returning to normal. So sales didn't slow at all. They were at a very rapid clip. So the other thing that happened is government programs were winding down their COVID programs. So that's already happened. So that's not going to be a continual decrease in government spending. And then finally, our economy is doing better than the rest of the world. So our exports tanked a little bit because the the global economy is not doing as well as we are. So just about everybody thinks that was an outlier, and we don't have to worry about recession happening immediately. I think the fear of recession is more like 1 to 2 years out is what people are. It's more realistic to consider that as a possibility than the fact that we're not going to go into a recession immediately. Demand is too strong for that to happen.
So when are we going into recession?
Well, historically, we've never had unemployment rate this low combined with an inflation rate this high when we hadn't gone into a recession within a year or two.
100%?
100%. But part of that, in terms of studies that economists have done, the one I've seen is that there's probably 1 year out, maybe a 60% chance, 2 years out, probably a 90% chance. And the reason is if the inflation is baked into the wage price cycle, there's really no way to get it out other than to create slack in the labor market. And the way you do that is through weak sales. Now, theoretically, a growth recession is possible. Theoretically, what you can do is if the Fed could engineer GDP to grow by just less than 2% a year, but still grow, that's not enough to keep track or to keep pace with productivity growth and labor force growth. So the unemployment rate would inch up if you're holding the GDP growth rate positive, but less than 2%. And that would slowly increase the unemployment rate to relieve the pressure in the labor market. But it's, to try to pilot that where you can slow down a really rapid growth rate, 5.5% or so, down to 1% without kind of overshooting and going to negative. It is a challenge, but it is theoretically possible. That's what they're shooting for.
So is that a soft landing?
Yeah, the soft landing would be if you could slow down GDP growth to maybe less than 2%, but not have it dip into negative territory. What that would do is it would over time create slack in the labor market due to productivity growth. Jobs wouldn't be growing as fast as productivity and population growth, and that in turn would then lessen that demand pressure in labor markets. That's what the Fed's trying to do. That's what they mean by a soft landing.
And from a small business analysis perspective, if your sales have rebounded and are going to be strong, it puts you in a pretty good position to conserve more cash during this time. Maybe try to pay off some of your higher priced debt, just kind of get in a better shape. Everybody likes to walk in and says, how can I recession-proof my business? Well, it's kind of like the pandemic. 4 out of 5 businesses were impacted at least moderately by the pandemic. And usually with a recession, it's kind of along those same lines. So you're going to feel some impact and some depth of it when that consumer spending tends to go away or goes at least a lot less. One thing that we talk to with individuals that are maybe older and have a business and are thinking about selling is maybe to accelerate that window in order to sell your business. Get those good results in, but maybe look to potentially sell the business and retire before potentially a recession does happen. So those are a couple suggestions that are out there.
I think those make a lot of sense because if we're right and in the fact, with the idea that if there's a recession, it's probably at least a year away, then that suggests that your sales are going to remain pretty reasonable for a year or so. So, use that to kind of buffer your, the impact a year down the road.
Mhm. Okay, let's jump into some questions we have here. First question, is the federal government still paying people to not work, thus making unemployment look lower? I'll take the first part of that, Doctor. No, they're not still paying unemployment. The COVID unemployment ended, I believe, the first week in September of 2021. But would that potentially make unemployment look lower if they were?
Well, I think you answered that question perfectly, but I think there was an implication of the oh gosh, I wish I could remember the statistic, but I think an overwhelming majority of families earning less than $50,000 a year, their liquid assets are greater now than they were pre-pandemic. So what has happened is just the average person, they can afford to be more choosy because they have the financial assets to look around. So it's not that the government's paying them not to work, but they are their balance sheet is in a position where they can look around more and they can be more choosy. They've got more time.
Okay, next question is related to the California minimum wage and the impact that has on salary increases. So the minimum salary in California this year is $14 and $15 an hour for 25 and more employees. Next year it'll be 15 and 15. So is that having an impact on salary rate increases?
I don't think it's having much of an impact because I think just the general inflation itself and the tightness of the labor market are creating enough upward pressure that the additional upward pressure being caused by that is probably minimal, would be my guess.
Okay, let's hit the chat real quick and see what else is in there. Oh, we had a chat from the poll actually relating to the severe lack of goods to sell. So the supply chain issues that are affecting small businesses, which in turn then affect inflation and higher cost. Particularly with inflation, the biggest driver, it seems like, of inflation is still energy cost, and that is prevalent in every aspect of our society. In so many different businesses, from delivery and other aspects that use some type of fuel or another. And I think that's it. So any last parting shots, any last words, Doctor?
Other than, I guess it's an understatement to say this is an interesting time. But I think you've touched on quite a few areas where it's, there's just a lot of areas where I think businesses really have to think through, what they're going to do in quite a few areas, in terms of credit, human resources, supply chain issues, everything else. So this seems like it'd be a good time to really get an appointment with your advisors at the SBDC and the other organizations in town that are offering business service support and really help think through these issues.
Well, it must be a great time to be an economist or a retired economist. It's probably even a little bit better. But it's also, it's a great period of time to be a business owner, even going through the last few years that you've gone through. So many more people are starting businesses now, more than any other time in our history, because of a lot of the benefits and a lot of the aspects of self-employment. And hopefully you realize that with the recession, the one thing I always like to impart on recession is that it's the one thing in your business that you can't control. You can control so many other things. Is all you can do is prepare for it and deal with it the best as it comes. So I think we're out of time, Doctor. So thank you, Dr. Mark Evans, for joining us.
Well,
And
thank you for inviting me.
for our producer, Maureen Busher-Dang, I'm Kelly Bearden. We'll see you next week on webinar number 114. Have a great week, everybody. Take care.